I want to tell you about two people. Both of them retired with exactly $1 million saved. Same amount, same age, same year. 5 years later, one of them is completely fine. Still has most of their money, sleeping well at night, living the retirement they planned. The other one is panicking. Their account has dropped so far that their financial advisor has told them to consider going back to work. Same starting amount, same investment strategy, completely different outcomes. And the difference between them had nothing to do with how smart they were, how hard they worked, or how carefully they saved. It came down to one single financial mistake, a mistake that most financial advisors barely talk about, a mistake that most people have never even heard of, and a mistake that is quietly destroying retirement plans all across America right now in 2026. I am going to show you exactly what it is and exactly what you can do to make sure it does not happen to you. The mistake is called sequence of returns risk. And before your eyes glaze over at that phrase, stay with me for just a moment, because I promise you, this is the most important financial concept you will learn this year if you are anywhere near retirement age. Here is what it means in plain English. The order in which your investment returns happen during retirement matters far more than the average return you earn over your lifetime. Let me say that again because it sounds simple, but the implications are devastating. Two people can have the exact same average return over 20 years of retirement and end up in completely different financial situations. One comfortable, one broke, purely based on whether the bad years came early or late. Here is the real data behind this. Research by Wade Pfau, a professor of retirement income at the American College of Financial Services, found that the compounded returns in just the first 10 years of retirement account for approximately 77% of your final retirement outcome. Not the full 20 or 30 years of retirement, just the first 10. That means if the market drops sharply right after you retire, and you are still withdrawing money from your portfolio every single month to pay your bills, you are selling assets at depressed prices and permanently shrinking the base from which your money can recover. And Morningstar's 2025 research confirmed it directly. Retirees who experienced poor returns in the first 5 years of retirement and did not adjust their spending were far more likely to completely run out of money. Their exact words described it as the single biggest threat to any retirement withdrawal plan. Go ahead and drop a comment right now if this is the first time you have ever heard of sequence of returns risk. I genuinely want to know how many people watching this have never had a financial advisor explain this to them. Because in my experience, most people have not. Now let me make this completely concrete with actual numbers so you can feel exactly what this does to a retirement account. Morningstar modeled two investors. Both start with $1 million. Both withdraw $50,000 in year one and increase withdrawals by 2% every year after that to keep up with inflation. Investor 1 hits a 15% portfolio drop in the first 2 years, before returns stabilize and average around 6% going forward. Investor 2 has 6% returns for the first 9 years, then hits the same 15% drop in years 10 and 11. Investor 2 is just fine. Still has significant savings well into their late 80s. Investor 1 runs out of money years earlier, despite having the same $1 million starting point and the same long-term average return. The only difference was when the bad years happened. Early losses combined with ongoing withdrawals create a mathematical hole that is extraordinarily difficult to climb out of. You are selling shares when they are cheap. Those shares are gone, and when the market recovers, there are fewer shares left to grow. And here is the thing that makes this especially dangerous right now in 2026. The S&P 500 dropped nearly 19% in the first half of 2025 before recovering to finish the year positive. Anyone who retired in early 2025 and started drawing income immediately got that 19% drop right at the beginning of their retirement in the most dangerous possible window. And through the first part of 2026, markets have remained choppy and stretched. If you retired in the last year or two, and you are taking withdrawals from a portfolio that has already taken hits, you need to understand what that means for your long-term financial picture, and you need to understand it now. But here is where the first part of this mistake gets compounded into something even more damaging. Sequence of returns risk does not just hurt you when the market drops. It gets dramatically worse when you combine a market drop with overspending, and overspending in early retirement is incredibly common. Most people think of retirement as having 2 or 3 phases. Researchers actually call them the go-go years, the slow-go years, and the no-go years. The go-go years are early retirement when you are healthy, energetic, and finally free from work. People travel. They renovate the house. They buy the car they always wanted. They help the grandkids with college. They say yes to everything because they have been saying no their whole working lives. And none of that is wrong on its own. The problem is when people do it without any framework for what their portfolio can actually sustain and without any plan for adjusting when the market turns against them. If this video is opening your eyes to something you had not thought about before, hit the like button right now. It genuinely helps more people in this situation find this content before it is too late for them to act on it. So what do you actually do about this? Because that is why you are here. Let's get into the specific strategies that protect you. The first and most powerful protection is building a cash buffer before you retire and maintaining it throughout retirement. This means keeping 1 to 2 full years of living expenses in a high-yield savings account, earning 4 to 5% annually right now in 2026, completely separate from your investment portfolio, completely untouched by market movements. When the market drops and your portfolio shrinks, you do not touch the investments. You live off the cash buffer while the portfolio recovers. This single move removes the most dangerous part of sequence of returns risk, which is being forced to sell depressed assets just to pay your electricity bill. You are no longer a forced seller in a down market. You have breathing room, and breathing room in the first 5 years of retirement is worth more than any investment strategy you can name. The second protection is flexible withdrawals. The 4% rule has been the standard guidance for decades, and Morningstar's current 2026 recommendation puts the safe baseline withdrawal rate at 3.9% for fixed spending strategies. But the research is very clear that retirees who use a flexible strategy, spending a little less when markets are down and a little more when they are up, dramatically outperform those who rigidly pull the same dollar amount every year, regardless of what the market is doing. This does not have to mean major lifestyle sacrifices. Pulling back discretionary spending by 10 to 15% during a significant market downturn and then resuming normal spending when things recover can be the difference between a retirement that lasts and one that does not. Third, this is exactly why delaying Social Security matters so much. Every guaranteed dollar of monthly income you have from Social Security is $1 you do not need to pull from your portfolio. The higher your Social Security benefit, the less pressure your investment accounts are under every single month. And when a market downturn hits, a higher guaranteed income floor means you can reduce or pause portfolio withdrawals entirely and still keep the lights on. Claiming Social Security at 62 and getting a benefit that is 30% lower than it would be at 67 or 70 is not just a Social Security decision. It is a sequence of returns decision. It directly determines how dependent your portfolio is on staying healthy during your most vulnerable window. Fourth, the bucket strategy gives you a structured framework that makes all of this more manageable and less emotional. Bucket 1 is your 1 to 2 year cash buffer in a high yield account. Bucket 2 is 3 to 10 years of needs in more conservative investments, bonds, dividend paying stocks, and stable assets. Bucket 3 is everything beyond 10 years in broad market index funds for long-term growth. When the market drops, Bucket 3 drops. But Bucket 1 and Bucket 2 are insulated. You refill Bucket 1 from Bucket 2 over time and refill Bucket 2 from Bucket 3 during market recoveries. The structure means a bad year in the stock market does not translate into a bad year in your kitchen. And that emotional separation between your daily money and your long-term money is genuinely one of the most important things a retiree can build. Subscribe to Wise Dude right now if you want content like this delivered to you every single week. We cover real retirement strategy in plain language. No jargon, no fluff, just honest information that you can actually do something with. Hit that subscribe button and turn on the bell so you never miss it. Fifth and finally, consider how part-time income fits into this picture. Any income you generate that does not come from your portfolio is income. Your portfolio does not have to produce. Even $800 to $200 a month from consulting, freelancing, or part-time work in the early years of retirement dramatically reduces the withdrawal pressure on your investments during exactly the window where sequence of returns risk is highest. You are protecting the most critical period by supplementing rather than fully depending on your portfolio. Once you are through the first 5 to 7 years and your investments have had time to grow on a less pressured base, you have far more financial flexibility. Share this video with someone you know who is either retired or close to it. Not because we need the views, but because this specific mistake is doing real financial damage to real people who have no idea it is even happening to them. One person you share this with might be sitting on this exact problem without knowing it. And knowing it early is the entire difference between having options and not having them. Here is the summary of everything. Sequence of returns, risk is the single biggest financial mistake most retirees make. Not because they are careless, but because nobody told them the first 10 years of retirement are the most financially dangerous decade of their lives. A market drop combined with ongoing withdrawals and unchecked early spending can permanently damage a portfolio that would have otherwise lasted 30 years. The fix is not complicated. Build a cash buffer. Use flexible withdrawals. Delay Social Security as long as possible. Structure your money in buckets and keep some form of income flowing in the early years. None of these are difficult strategies. They just require knowing the risk exists before it hits you, and now you do.